Welcome back to This is Jax. Today I want to talk about something that I've been getting some calls on, and it has to do with escrow shortages. In fact, I helped some folks sell their houses last year. Kind of found them in a spot where, hey, listen, the bank called me. There was an escrow shortage in my account, and now I can't afford it because I have to pay X amount of dollars to bring the escrow current, and then my payment's going to go up X amount of dollars to make sure there's enough money in there next year before it'll settle back down, but still at a higher point than where I started. So this has caught some people off guard. It's definitely a learning moment. Welcome to This is Jax, a hyper-local podcast. We're going to do our best. We're going to bring on successful business owners, the people who drive the cities, share a lot about what makes our city so great. So you can be confident and comfortable. This is a city that you want to call home. Nobody wants to learn a lesson with their finances in a way that puts them in a position where they might potentially lose their house, or where they have to sell a house that they love, rent it out, whatever, but they find themselves in a position. So I kind of want to talk about why is my payment going up after 2 years? I don't understand. I bought a new house. I was told the payment was going to be X, and now it's Y. Why is this? And it happens a lot with new construction, which is specifically what we're going to talk about. So this might seem kind of like a general topic, but it's very close to Jacksonville, because I know there's some particular neighborhoods here in Jacksonville where, unfortunately, the builders were kind of doing something that some might think was almost predatory lending practices. So we're going to talk about what happened, why it happened, and what we can do to prevent it in the future. So thanks for tuning in today. I can't wait to get into that. We just are starting off a new year here. It's 2025. We're 2 weeks away from a presidential inauguration at this point that we're recording this. So first week of January, I'm really getting after it. It was tough having Christmas week home with the kids. Really enjoyed that. But by that point, you're like, Halloween came and Thanksgiving break and all the parties and all the events and vendor events, client appreciation events. You're really having a big month. And after Christmas, I'm just ready to get back after it. You know what I mean? I'm ready. And then boom, we start Monday, Tuesday. I start picking up some momentum, and Wednesday is New Year's Eve or New Year's Day. And we got a day off work. Our staff is off. The banks are closed. The title company. So kind of had a forced day off there in the middle of the week last week. Those Wednesday holidays are tough. So now we just rolled around first Monday of the new year, and I'm happy to be here. So ready to get to work as we close that chapter on 2024. I can't help but reflect kind of on the year filled with growth, challenges, heartwarming success stories. Was a really challenging year. 2024 was a tough year to be in real estate, to be in the industry. We've got an election cycle, so there's a lot of noise, a lot of people sitting on the sidelines waiting to see what happens. Interest rates, we started off the year with super high interest rates. They came down, and so that sweet spot, like I had a really busy summer. But then come Q3, Q4, once it's election season, it just really fell off. People waiting to see what happens. And we talked about that on a few episodes. And then you got the holiday season. So tough year to deal with real estate. Oh, and I forgot to mention, then we had that big lawsuit at the beginning of the year, the first half of the year. Everybody's waiting to see how that's going to play out. Turns out not much has changed in the industry. I think some professionalism and some standards, some practice things have changed, which I'm all there for. So for me, those were things I was already on board with. So I don't need a lawsuit or some sort of like forced, like, hey, you're now going to practice this way when you're already practicing that way. Man, life is good, right? But listen, the Riggs Group, proud to have helped 20 families sell or buy their homes, closed a total of $8.5 million in volume, which is pretty good. And each transaction wasn't just about buying or selling a home. It was really about helping clients. They were turning the page, the next chapter of life. Some were finding a dream home. Others were just, it was the next step. So really happy for them. Listen, and 20 units, that's a lot of families to help. I'm really proud to do that, but we're setting the goal huge. So my goal this year is to help 50 families sell or buy real estate in 25, and I really need your help this year. My entire business is based on referrals, past clients, and my forever clients. So I'm making it fun May 21st, hosting my VIP dinner at the Refinery Jax Beach on me. I'm taking anyone who sends me 2 referrals that close out to celebrate with me. I'd love for you to be there. Statistically, everyone knows 3 to 5 people that sell or buy a home each year. I'm only asking you to send me 2 referrals that close before May. So email referrals to nate@riggsgroupfl.com. I want to talk about monthly payments. Why are monthly payments going up? I mean, typically after the second year, I've had some clients call me. Actually, in last year, I had someone call me. Ironically, those people bought like 2 years prior to that. And then just recently, I had another past client call me, and they're like, "Hold on, we got bad news," and it is bad news. It's news that would hurt a lot of people, hurt a lot of families. And what's happening is there's an escrow account. So let's break it down first. When you pay your mortgage, you're paying your principal and interest, and then you're paying your insurance, and then you're paying your taxes, and that goes into your escrow account. So your principal and interest goes to your loan provider or your loan servicer once a month, and then your home insurance is taken out annually once a year, and then your taxes are come out once a year. Now, what happens is, to make this easier on people, we will divide the annual bill by 12 so it becomes a monthly payment. So let's do some easy math. Let's just say your principal and interest is $2,000. So $2,000 is going to the actual mortgage of your house, and your insurance was $1,200 a year. So you're going to have an additional 100, right? 1,200 divided by 12, that's 100. So now your payment went from $2,000 to $2,100, 2,100. Now your taxes, how much are those? I'm going to throw a number out here. This is just to kind of like get it going, but say it's $300 a month, or $3,600 annually. So if your taxes are $3,600 annually, which honestly, that's a pretty low tax rate. So congratulations, but for easy math purposes, now you're paying $300 a month. So that $300 to your taxes, 100 goes to your insurance, and then the 2,000 goes to your principal and interest. That's all getting collected together in your monthly bill of $2,400. Hope I did the math right on that. I didn't draw it down on a paper or anything. So don't at me in the comments if I did. Anyway, that's what structures your payment. Now, this is why typically your payment can fluctuate maybe 20, 30 bucks a year, like especially if you're in a CDD neighborhood, which we're not going to get into, but there's a board that votes on a budget, and that's the care and maintenance of operating your neighborhood, all those common spaces. Like if you have a pool in your neighborhood or ponds that need, lake doctor to come service and make sure they're not full algae or whatever. But your bill can go up or down based on the annual budget of your community. If you don't have that, it just typically stays the same unless your insurance provider makes some changes, then, or maybe you shop insurance and, hey, this guy's giving me the same coverage at a really great rate. I'm going to save $200 a month. Congratulations. That is the way to go. Unfortunately, what is happening to some folks is they're buying a new construction home, and because there was no home on the land, that tax rate is based on the assessed value of your home. However, when the builder built the home, there was nothing on that land, so the assessed tax rate might be much lower. So here's an exact example. Maybe that lot was only assessed at $15,000, and you have to do some calculations, but that times the millage rate, etc., ends up being what the tax bill is. Well, that tax bill is going to be really low at $15,000 times X versus, hey, your assessed value is 300,000 times X, or 400,000 times X, right? If you're following along there, it's pretty easy to see, like, yeah, that bill is going to be drastically different. So it might go from a $2,400 tax bill to a $7,000 tax bill real quick, or even less. So what we have to pay attention to is several things. And unfortunately, what's happening to folks is they're going to buy a new construction home. They're estimate is wrong at closing. And whether they were told about it or not, it kind of, there's a lot going on when you're signing a 70-page contract, when you sign that stack at closing and it's this high. It's a lot of information coming at you. And there's usually some disclosures in there that say like, hey, let it be known that like your value of your home is going to go up. As such, the county will collect more taxes from you. But life goes on. And so that you paid in the first year, the second year, it hasn't really hit yet. So you pay again. And then what happens is the third year it hits and the county wants its money. And there's no money in the escrow account. So what happens is the loan service provider, they call you and they're like, we need the back money because the county's saying, hold on, you've lived here for 2 years. We might backdate this and get our money because, that's how the government operates. And so you are going to have to pay that money. Then, now we have to fatten up the money pot. So we're going to start collecting more money from you. And then once it balances out, your bill will come back down, but it's not going to come all the way back down. It's still going to be 200, 400, 500, whatever the number is, more than it is today. This hurts a lot of people. I don't know about you, but most of the people listening, I myself, if my bill just went up $500, that would not be fun. It would hurt. Certainly if it went up $1,000 or $2,000, I'm in trouble. I'm looking for a new place to live. Right. So that's not a place we want to be. So who's really at fault here? The answer is, unfortunately, no one really. It seems kind of predatory, especially when the developer is saying, hey, you qualify for this much payment. You've qualified for X payment. And we have our in-house lender that qualified you and our in-house title company that drew up all the paper, and we're going to pay your closing costs. Well, why didn't they fill up the escrow account? Say they built 1,500 homes in that neighborhood. If they only put $2,000 in your escrow account versus the $8,000 that it needed, do the math there, right? They're saving a ton of money. And the law only asks them to do an estimate on what's in front of them. They are not required to make an estimate based on, I know it seems simple. Like we should just say like, hey, they knew, why didn't they look at the neighborhood that's finished across the street and see that everyone was paying $8,000 in taxes? Should they not have put that in the escrow? It's tough to say, right? On one hand, you're like, yeah, absolutely. That makes sense. But to have a government regulation, a law that is based on like what ifs and unknowns, that's really tough too. I mean, I understand that looking at a big box builder, a corporate builder, we want them to have that, but then that's kind of a blanket policy. And I don't want the government doing that to me. Side note here, the government was floating this idea of taxing you on proposed gains, meaning if you bought your house for $100,000, but you could sell it now for $1 million because you could get $900,000, we're going to tax you on that. That is not cool. We don't want that happening. So that is kind of the same example of what it would mean to do that estimate. So I get it. I understand. However, is there there's a little bit of self-responsibility there. Like it's a 70-page contract. It's a loan estimate that you have to read. And just how we can point the finger at the developer and say, okay, they knew the neighborhood across the street paid $8,000 in taxes. Why didn't we? Okay. Well, at the same time, me as someone who's purchasing a home, reviewing my finances, reviewing the loan estimate, can look and see how much money are they putting in the escrow. Okay. This number is significantly less than what they're charging for taxes on the neighborhood that's finished just across the street. So I can make the assumption that this number is not enough. So either I need to put money in there myself, or I need to negotiate for them to put more money in, or if neither of us do, I need to be prepared for my bill to go up. So I either need to pay more into or savings. Anyways, we're going to get in all that. I'm going to actually talk about a few steps new homeowners need to do to prevent escrow shortages. Just bump the thing. No big deal. Okay. So we already kind of touched on them a little bit. I kind of was just going down the line, but I'm going to read these steps to you, kind of make it simple, cut and dry. So the first thing, verify estimated property taxes. New homeowners should request a detailed estimate of property taxes for a completed home from the builder or lender. So we just talked about that. You're going to get that. You're required to get that. You're going to get the loan estimate. You're going to get all these, the ALTA. And I know those are terms that you're like, what is it? Well, when you work with a professional agent who's working with you, they're going to point these things out to you. Now, remember, your agent, they're not a tax professional. They're not an attorney. They're not a lender. What they're helping you do is work towards narrowing down what your needs are, what your wants are, giving you suggestions on what part of town you should live in based on those things. They're kind of taking you to the properties. They're helping you negotiate. They're letting you know whether you're making a good financial decision based on price point of the home and stuff. That's really their area of expertise. But your agent that's representing you isn't really a tax professional. So ethically and legally, they're not even really supposed to get into like that stuff. That's really the responsibility on you as a homeowner to read that. So they can kind of point that stuff out to you like, hey, like I'm doing right now, you need to make sure that the property taxes are what they should be. You know, it should be based on the projected value of the construction, not just the land value. But the law only requires the lender to do what's there now, which is just a land value. So you've got to kind of take a little bit of self-responsibility and make sure you're with that. Often the developer will only cover the estimates based on what is in front of them or the value of the land. That's all they're going to do. So you need to try to get more in there or be prepared to, pay into it. Second thing is review your escrow calculations. So, you got to review that initial loan estimate provided before closing. They can consult with a lender. Now, I know that most home buyers who buy new construction, in order to get the incentive, hey, we pay all your closing costs, you have to use their in-house lender. If you're working with a professional agent, they should have professional mortgage brokers and loan originators who are in their wheelhouse who, trust me, they will do it anyway. I have mortgage brokers that I work with super close, and I've done new construction deals, and they have reviewed those deals for me and for my clients, and they can help you do this. So there's always somebody. Get a third-party opinion. Go talk to a real estate attorney, so another title company, and it might cost you a couple $100 to have this conversation, or most of the times they'll do it for free. I mean, the people I work with will do it for free. We do a lot of business with them. We have great partnerships, so I know that they're always willing to help people out. And listen, to incentivize it, when you go to sell that house, you're going to be able to find your own title company stuff. So they want your business in the future. So they're always willing to help and be the example moving forward. A good one is anyways. So you can help that. That helps you spot discrepancies early and address any potential shortfalls. The fourth thing that you can do, this is the third thing here. We can monitor the escrow statements. Homeowners should regularly review their annual escrow analysis. So listen, you get the thing in the mail every month. Most people say go paperless and save 50 cents. I don't know what it is. Or if you just out of your heart want to go paperless, or you don't want the mail, whatever. I don't care what reason why. We all go paperless these days. And so most of us just delete the email when it comes through. Some people look at it, but you need to be tracking. Okay, are they taking it out? And a lot of times your loan servicer, your loan gets sold. So this developer will close on this loan and then they'll sell it off. And it might be this bundle deal, whatever it is, but you need to make sure like, hey, I've had people who call and they're like, oh my gosh, my bill just shot up. Like it went down $300 last year and I was excited. And now it's like, apparently they messed up. And it's like, well, yeah, you didn't think, what did you think happened? Your bill went down. Like, yeah, that's not normal. So, monitor those escrow statements. The fourth thing, increase your monthly escrow payments. Listen, if you suspect there's going to be shortage, or I know some folk where you're like, hey, that's a low escrow amount. That's okay. I want the payment right now. It's going to kick in 2 years. I'll be ready for it then. I've got this inheritance coming. I've got a new job coming online. Whatever the reason is, it's easier for them to make that lower payment up front. But in a year, they'll be prepared. So they'll set money aside. You can always do that too. All right, the last thing is this. It doesn't have to do necessarily with taxes, but it has to do with your insurance. You need to ensure that your homeowner's insurance premium, it's accurate and it reflects the cost of insuring the house once completed. Typically it is. Most insurers are not just going to like accept, you and give you a policy without doing that estimate. Those are all things. Listen, there's a couple different laws. We're going to touch on them real quick. Florida laws and regulations that protect homebuyers. Truth in Lending Act. This is TILA. Real Estate Settlement Procedure Act, RESPA. These laws ensure transparency, but they don't specifically protect against builder underfunding. So once again, the responsibility is back on you as a homeowner or as a home buyer. And the best person you want to talk to in most cases, aside from just going to the county tax records website and looking to make sure, but talk to a third party lender or talk to the real estate attorney to make sure that you're getting an accurate thing. Florida homestead exemption. This is something you can do. Homebuyers can apply for a homestead exemption. It's going to reduce their taxable property value, but it's not going to, make up thousands of dollars by any means. Consumer protection laws, Florida Deceptive and Unfair Trade Practices Act, so FDUTPA. It could offer some recourse, but you got to think if there's an escrow shortage of $3,000, how much is an attorney going to cost? Then I got to file for this lawsuit. In the meantime, am I paying my attorney versus paying my actual mortgage? Like the cost may outweigh the benefit there. Keep that in mind. Everybody likes to say, sue that person. Well, it costs $30,000 to $50,000 in attorney fees to sue someone. Sometimes that's more than making up the $3,000 to $7,000. Now, especially when your chances of beating the person you're suing are, not very good because, I'm just putting it out there. Listen, at some point, we've got to have some self-responsibility. Everybody is learning stuff. You hate to learn lessons these ways. But look, you've got to read those lines, right? Could be legal recourse, but maybe if a whole neighborhood, like in this case where I'm starting to hear potentially that like a whole neighborhood, this happened to, there may be potential there now for the community to band together. Maybe they could have one attorney or one team of attorneys. So the cost is spread out over the entire community. And then if they actually are right and win, then, they hopefully don't have to pay those legal fees or get some sort of reimbursements. That's kind of like a class action lawsuit type thing, though. Again, a challenging process that takes a lot of time. What's going on in the meantime? How are you paying your bills in the meantime, right? So just kind of think that stuff. Recommendations, definitely consult a real estate attorney, work with a lender, and just stay proactive. You got to regularly communicate with the lender and monitor of tax assessments to create potential issues. It's a serious thing, and I know that information just was like, wow, it was all out there, but it's pretty important stuff. So if you're thinking about buying a new home or you bought a new home recently, you need to stay on top of those escrows, stay on top of that county property appraiser website, and make sure that you're paying in the right amount so that you don't just get a random phone call that like you're $7,000, $10,000, $15,000 behind, because that would really hurt. So if you're planning on selling your home in 2025, you need to start prepping today. The process to sell your home, really from initial strategy meeting to the time I come to your house, to the time that you close on your sale, it can take 3 to 6 months. Okay. Data shows that profits peaked in April of 2024. We're talking that's 3 months away already. So if you want to walk away from the closing table with the most money in your pocket, you need to start thinking about it today. Head to rigsgroupfl.com/sell my home. Fill out the consult form. Schedule your free real estate strategy meeting today. You're listening to This Is Jack's podcast. For more information, contact me. Go to rigsgroupfl.com.